Market to Market is everywhere you are. Subscribe to Market on YouTube, find us on the PBS video app to stream on demand, and add our 3 podcasts on your favorite podcasting app.
Welcome into the Friday, September 30, 2022 Market Plus. Again, joining us remotely, Angie Setzer, Chris Swift. Chris, I want to go back to you for a minute on this first question because in your newsletters, you talk about the economy quite a bit. So Paul in Danvers, Minnesota is going to set this discussion here. He says, if demand falls, production is not here this harvest, talking bushels and tons, and inflation continue to rise along with interest rates. What will the farm economy look like in a year or two? What do you think, Chris?
That's a great question. I would have to say that it probably reduces it some. I'll speak specifically of the beef industry. We saw a lot of vertical integration take place this year. Vertical integration is an attempt to strengthen supply chains in order to reduce the price volatility. So as we see that going forward, we believe that especially in the cattle production business, where we're going to see less price swings, it really cuts the margin down on a lot of production. We see sometimes we pay a little bit too much for feeder cattle coming into the feed yards. Now we hope that the price of fat cattle rallies so we can either lay them off or sell them at a higher price in the future. And that's probably going to narrow going forward more so than widen out because of that vertical integration. So from the input standpoint of grains and row crops, generally, we're not going to see much of a backup in that, especially with equipment and some of the aspects that are going along with that equipment that is going to keep that from going down. Unfortunately, until you get into a recessionary type frame, where you see more of the expenses the higher expenses that we paid for products start to be unmanageable, they begin to sell those off, then we can see some return back to it where people have gotten deals on combines, tractors, maybe cattle prices have gone down enough where there's some margin in it. But that's the one thing that is probably going forward from this point is we're going to lose more and more margin to the farmer because we are going to see input costs. And of course, the consumer wants a really low price. So we're always in a constant battle between wanting the highest price for the farmer and also producing enough product to where we keep the price low to the consumer.
Angie, I guess I ask you the same question in the sense of the overall economy. What do you see us here if these things laid out that Paul's saying, if production is lower and inflation grows? What are we looking like here economy-wise in a year or two?
I don't like it. I mean, can we say that we look better as a whole in the U.S. than a good share of the world, I think, potentially as producers? But from a farm economy standpoint, we've all lived through, or a good portion of us anyway, like remember 2014, 15, 2009 into 10, some of these times that came after great booms, were really quite painful. And right now, from an economic standpoint and things of that nature, I think things get quite perilous going forward. I think, like I said, on a good note, I think the U.S. and the U.S. farmer for that matter are probably going to be mostly okay. But it is going to be a battle. It's not going to be easy. It never has been. But it unfortunately, I think it gets even harder in the year ahead.
Well, we always have the basis to look upon, right? To help us out? Okay, not really. But that's what our next question is about here, Angie, is the basis. And that is actually one of those wild cards. Gavin in McCook, Nebraska asking, will record basis levels soften if futures run higher for the Western Corn Belt?
Potentially. I mean, we're in a weird situation. We're in a very different cash market situation than I think we are gathering. And I think a lot of folks are gathering. When you look at like rail times and rail performance as horrible as it has been, and some of these other things, like from a logistical standpoint, nothing has been fixed. Like we averted the strike, but really have we? There's people that are on the inside of that have spent a lot of time talking about that said the rail strike it might not be on the table currently, as in it happens in a week, but it's something that we can't say doesn't take place. And so I think that you could see futures rally and see basis remain stout just simply because we don't have logistical capacity to move the bushels that we need to, at least in the short term, and that could create an issue.
Okay. I want to move to my next question, which is a global outlook again, Angie. This one's from Phil in Dresden, Ontario. And he says the Russian invasion of Ukraine changed everything. As we head into fall and winter, is there potential for even greater grain price volatility with the reality that Russia-Ukraine 2.0 could get worse? Is the world relying too much or too heavily on Brazil to balance supply?
Yeah, that question, I read Phil's question earlier today, and it's kind of stuck with me for a while on there. Are we relying too heavily on Brazil to balance supply? And I would say, yeah, we are right now. I mean, Brazil's the only game in town going forward for a short period of time. Now, obviously, you say Brazil, and it encompasses, I think, in a lot of folks' minds, it basically encompasses the bulk of South America. Argentina is going to up their soybean acres, according to reports this week, and potentially increase production there. But yeah, I think, really when it comes down to it, Brazil's going to be the one that is going to step in and probably bridge a gap. I think we're discounting how much Ukrainian grain is going to help offset the drought loss that we saw in Europe, simply because of the bulk of that Ukrainian grain that's not being loaded out of the Black Sea ports is moving rail, truck, river, all of these ways that we figured out how to bump Ukraine exports from 0 to 4 million metric ton before we reopened the shipping corridor. I think so. I think there's a lot of things that are going on in global trade that are going to be interesting. But yeah, I think the potential is there. We could be counting on Brazil a little too much. But I also think, thinking of Phil specifically, but I also think we may be forgetting about the impact that the drought in Canada had last year, and that we're not really looking at that same sort of scenario this year either. And so everything's very different. But I think we have to keep this market supported just simply because we don't know what's going to happen with Russia. And
Right.
Until that's resolved, which God knows when that'll be, we're going to see market volatility kind of continue to grow or at least remain entrenched in this thing for a while.
Chris, what do you think about this influence of Brazil and Ukraine on grains? I mean, you watch the grains, but is there a different story for the livestock industry when it comes to these other two big, I'll call them competitors, contributors to the overall grain complex?
Sure. Pertaining to corn, not as much. Soybeans tends to be the bigger crop grown in South America, and wheat tends to be the bigger crop in the Ukraine. So to the cattle feeder, we're much more concerned with the U.S. crop right now on corn. Inflationary factors are probably here to stay. Our Fed has told us they were going to raise rates. They told us to expect some pain. They have delivered upon both. So now they're telling us they're probably going to continue to raise rates. So at the moment, I'm going to believe them. And we look at some conflictions. We still have China over there supporting their economy with lower interest rates and now a threat of potentially manipulating their currency. We have England that stopped a gilt sale this week in order to stave off the pension funds from going under. So we've got some major economies moving in different directions, making it extremely volatile to try to predict much of anything other than here domestically in the U.S. And because that is where the most of the inflation is and where we see our particular administration telling us we're going to have more inflation. Right now, we just have to believe them.
You'll take your punishment and you'll like it, right? Isn't that kind of what I'm getting that you're saying there, Chris? Okay.
It's kind of like we're being told this, so you either buckle down and accept it, or you can try to fight it, and that tends to be a very painful fight.
How many times? Go ahead, Angie.
Over the last few years, we've been told not to fight the Fed when it came to quantitative easing. And so I think we have to be very, very cognizant of not fighting the Fed when the monetary policy shifts.
Well, QE has been a thing. Ted Seifert, we've had hallway conversations after we've recorded, and we don't always talk about QE, the easing as much. Where's that discussion, Angie?
The Fed is slimming down its balance sheet. So we're back into that quantitative tightening sort of role. And so at least here, And so, yeah, that's the discussion that we
Yeah.
have, is that influx of cash. And so I've been saying to a lot of my customers, like, if you look at a chart after COVID in May of 2020, when Jerome Powell sat during his 60 Minutes interview and said that the Fed had basically infinite power to help support the economy, the next day we rallied and didn't stop until 21 when the Fed, or 2022 when the Fed said, oh, we're going to make prices stable again. And so I think when it comes down to it, you just don't fight the Fed, at least for now, because
Okay.
they have made it their mandate to break prices.
Last thing
and
here, Angie.
Lower values.
Okay, sorry. I want to get one more
No, you're
thing
fine.
in about 23. I want to go to Schilke's question. He's always
Yeah.
good. Good to hear from him. It'd been a while, so you're always welcome, by the way. Fertilizer. He says, personally, I bought all my nitrogen and phosphorus needs for 23 sometime in July and offset the purchase with a Dees 23 corn sale for the same gross dollar amount. Am I a fool, or is this something producers should be doing? He says it's been a good recipe for him in the past.
It is definitely, especially in a year like this one, a recipe for producers. I mean, for us, we've been talking about covering fixed costs for a while for 2023. And then if you are sticking your neck out, if you're purchasing inputs, you're committing to farm again. So if you are sticking your neck out, make sure you're doing something to cover those costs, because
Okay.
there isn't anything that says, I know everyone wants to say that the crop is smaller and we have to move higher and this, that, and the other thing. But the reality is there is not anything that says that we do have to move higher. And there also isn't anything that says that, based on the global situation that we're in and the energy crunch that we're seeing in Europe and the problems that we're seeing with fertilizer exports out of Russia and things of that nature, you could see inputs remain elevated and grain prices fall, which is a worry.
Yeah.
But you could also see inputs fall off and grain prices fall off. And so, if you're doing one, make sure that you're looking to do the other, and just kind of keep yourself more in a back-to-back sort of market structure as best you can. And then also, just really focus on that margin. Don't get too caught up in trying to guess where this market's going to head, because no one knows.
No one knows. I do know one thing. We're out of time. Angie Setzer, Chris Swift, good to see you both. Have
Thank
a good
you.
have a good week, and we'll talk to you again soon. That's Angie Setzer and Chris Swift. Next week, we're going to talk and look at the crop not the crop. We're going to look at the outlook for the livestock market in Oklahoma. We'll also have a conversation with our friend Sue Martin. That's next week. That's it for Market Plus. I'm Paul Yeager. Thanks for watching. Have a great week.